Okay, now that we've gone through chapters 1 and 2 and we've discussed the participants in the marketplace, the regulators in the marketplace, it's now time to discuss the exciting world of the various products. So the next few chapters you're going to listen to is going to be covering section 2 of the SIE outline, which talks about the various products one can purchase in the marketplace. So that's the focus of the next few chapters. Chapter 3 is going to be equity securities, and it covers 2.1.1 of the SIE outline. And there's a good number of questions in section 2. So section 2 is 44% of the exam, or 33 questions. And that doesn't include the experimental questions. So it's a fair number of questions. They're not going to be all about equity securities, of course, but they'll cover all the various products in the next few chapters. Second of all, a lot of these products, equity securities, debt securities, and things of that nature, are covered in the SIE sort of on the light side. They're covered much more in detail on the general securities exam, which is referred to as the Series 7. So, what's going to happen in Chapter 3? Well, the following. There are going to be 5 sections of Chapter 3. First, we're going to discuss the corporate structure, the various types of securities corporations will issue. Then we'll talk about the characteristics of one of those products called common stock. So we'll talk about the benefits of common stock, some characteristics. Then we'll talk about the classifications of common stock, the term blue chip, or defensive, or ADRs, things of that nature. Fourth, we'll talk about another type of equity security known as preferred stock, and the characteristics of preferred stock, a little bit about them, limitations, and last but not least are rights and warrants, which are types of derivative securities because their value is derived or comes from the value of the common stock, which we're going to talk about in the second section of this presentation. So every corporation has what's called articles of incorporation. That's just simply the legal documents or the corporate charter that establishes all the information and legal details of the corporation. And we don't have to spend that much time on that, of course. One of the key things about corporations is they have what's called a board of directors. A board of directors could include people that work at the company as well as something called outside directors, sort of like an independent level of management. And the board's responsibility is to oversee the management team. Corporate governance is to govern the corporation. And, very important point for the exam, they would declare dividends. So shareholders don't declare dividends, the board does. So the board of directors is responsible for dealing with the management. The management runs the day-to-day business, president, various officers of the company. And some of those individuals could also be on the board, but there's also a good number of outside directors. Many of them come from politics, some come from athletics or universities, they're retired. Sometimes you'll look at a board of directors and there'll be 4 or 5 members who used to be the CEOs of other companies. And some individuals are on a number of different boards. One other point I'd like to make is, we'll talk about it more in other chapters, but when you vote and you're not able to attend, they have to refer to as what's called a proxy. So the term proxy simply means you're allowing someone to attend a meeting to vote on your behalf, but you're going to tell them exactly how you want to vote. Now, in an earlier chapter, we talked about how corporations raise money. Let's go a little further on that. There are 2 general ways in which companies raise money: to run the company, to buy other companies, to build plants, to hire employees, grow its business. One of those is referred to as debt or bonds, and the other is referred to as stocks or equity financing. And within that, there are other subcategories. So bondholders, where you lend the company money. The point senior to equities refers to bankruptcy. If a company would declare bankruptcy, bondholders would be paid before any equity holders. And last but not least are the 2 types of equity securities. One is common stock and the other is preferred stock. And the term preferred being senior, if there was a bankruptcy, bondholders would get paid first, then preferred shareholders, and after preferred shareholders, if there's any funds left, then common shareholders. That's known as junior versus senior, the ability to get paid prior to someone else in case of a bankruptcy. So again, bonds are going to be the subject of chapters 4 and 5. Today's discussion is going to focus on equity financing, common stock and preferred stock, which is chapter 3. Now let's get involved in some of the terminology around common stock. So the next few slides are going to focus on common stock. So first of all, we have the term authorized shares, and we have here the words initial public offering. But let's take a step back. Some companies are small, some companies are large. The examination focuses on publicly held companies, but there could be a privately held company, which means they haven't sold their shares to the public, where there's only 10 shares out there. 6 are with one person, 4 with the other person. One person owns 60%, the other owns 40%. But that's not really what we're going to revolve around here for our discussion. We're referring to public companies which sell their shares to the public. So we have the term initial public offering, and the charter determines how many authorized shares are. What does it actually mean? Authorized shares indicate how many shares the company can offer or can sell. The amount they actually have out there is called the issued shares, and that could be with either given to their own employees, as part of their compensation. It could be shares that have been purchased by people in a public offering. And then the third term is outstanding. So if we take the number of authorized shares, the number you can issue, let's say it's 1 billion, and you've only issued 10 million, then therefore the outstanding shares would be 10 million. It equals the same exact number. Now, a couple of other points we want to make on this, which are going to be followed up by the next slide, is this now means the company can issue many, many more shares to get to the 1 billion number without increasing the number of authorized shares. And one of the only ways to increase the number of authorized shares is the board would have to approve that and then follow that up by the shareholders approving that as well. So let's take this concept and build upon it with our next slide. Sometimes a company, a publicly held company, will purchase its own shares back in the marketplace. Some people refer to it as a stock buyback. There are many different terms. And pay careful attention, because the last slide today, one of the last slides today, talks about certain rules. And there are certain regulatory guidelines when a company buys back its own stock. So later on, when we talk about something called Rule 10b-18, I'm going to bring you back to the share buyback. Sometimes if companies have excess money and they make a profit, they may take some of that additional monies and decide to use those funds to buy back their shares. A couple of reasons they would do that: there'd be less shares around, and by having less shares around, there would be possibly an increase in the market price of the security. Sometimes companies will simply buy back its shares so they can offer those shares to employees. Many large public companies have something called stock option plans. And one of the ways they receive those stock option plans is by receiving or getting the stock on shares they have purchased back. So let's take a look at this example relevant to the exam. And we're going to build on our other example. So if we have 1 billion shares authorized, they've issued 10 million. Let's assume the following example. What if we purchased 2 million shares and they go into what's called treasury shares? That would leave us with a negative 2 million of the 10 million. The number of outstanding shares would decline from 10 million to 8 million, reflecting the fact that the share buyback or those shares went into the treasury. Now, treasury shares do not receive any dividends, nor do they have any voting rights. They're shares that the company has repurchased in the marketplace. One other important point is that many professionals or people in the marketplace use a term called market cap or market capitalization. And what that refers to is a very simple formula. It's the number of outstanding shares, not issued, not authorized, not treasury, the number of outstanding shares multiplied times the market value per share, which changes on a day-to-day basis. So if there are 8 million shares outstanding and the price per share was $1, which is a very small number, of course, the market cap would only be 8 million. If it was $10 or $100, it would be 80 million or 800 million. And that number changes every day as the market price per share changes every day. And lastly, again, treasury shares would not receive dividends. So if I said to you or asked you, if there's 8 million shares outstanding and there's $1 dividend, that means they're paying out $8 million. And if there were 10 million issued and 2 million were purchased back, you must remember to subtract that and get the number of outstanding shares, which would then be 8 million. That's an important figure to go. One of the interesting facts about the treasury shares and number of outstanding would be a term called earnings per share, which is going to be discussed more in detail in another chapter. But just to give you a simple example, if this company prior to the treasury shares earned, let's say, $10 million, the amount of profit they made is 10 million. If there are 10 million shares outstanding and they made $10 million, the amount of money they earned per share would be 10 million divided by 10 million, or $1 per share. If they earn that same $10 million and they purchase the treasury shares of 2 million and use some of their excess funds to do that, and they maintained $10 million worth of profitability, if we took 10 million and then divided that by not 10 million shares, but 8 million shares, the earnings per share would be found by taking 10 million divided by 8 million, which is $1.25 per share. So by repurchasing some of their shares, assuming they have the money to do that from previous profits, they could increase their earnings per share, like in my example, from 10 million, keeping the 10 million, and going from $1 per share to $1.25 per share. Okay, next up is the common stock ownership rights. So let's go through a couple of these items. Okay. Inspect the books simply means that you're going to receive information from the company, reports such as they refer to it as a 10K or an annual report, or 10Q, which is a quarterly report. You receive a certificate that you own the shares. Interesting point about that is from a previous discussion, if you actually receive a certificate with your name on it, which is very rare, that will be called your name. But if you held it at the brokerage firm, which the vast majority of people do, they call that street name. Transfer of ownership simply means the right to sell your shares to someone who will buy that. And that's called the secondary market. You can participate in corporate earnings, but they have to be declared and paid out. That's referred to as the dividends. And what we mean by dividends not guaranteed is if you own shares of common stock, the company determines whether or not they're going to pay you a dividend. Well, if they don't earn any money, they can't pay you a dividend. Even if they do earn money, they may decide to reinvest those funds back into the company and not pay you a dividend. So dividends are not guaranteed by a company. And lastly, you have voting power. We talked about that term, a proxy, where you can't show up at the meeting. But if you're going to vote as a shareholder, you have limited voting rights, generally for the election of the members of the board. And you could also vote for an increase in the authorized shares. But you would not vote. Make sure you make a note of this for the exam. You would not vote for dividends. You would not vote for cash dividends or stock dividends. But you would vote for the increase in the authorized shares and stock splits, but you would not vote for any type of dividends. Now, furthermore, in this example, we have two main voting methods when it comes to members of the board of directors. Statutory, 1-for-1, and cumulative, where you can accumulate or take all your votes and elect them or distribute them any way you want. Now, generally speaking, statutory would favor the larger shareholder, where cumulative could benefit the smaller shareholder by having the ability of having all their votes for 1 or 2 members of the board. Let's look at an example. Assume the following. There are 4 candidates running for 3 seats in the member of the board. So there's 4 candidates running for 3 seats, and you own 300 shares. Let's look at statutory voting and look at cumulative voting. Either way, the total number of votes will not change, and that'll be 900. And 900 is found by taking the 3 directors and multiplying it by the 300 shares. You vote 300, 300, 300, 300, and candidate D you decide not to vote for at all because you're only allowed 300 total shares. So therefore, your total votes are going to be 900. In cumulative voting, you can have 800. In other words, you have 900 total votes, of which you can allocate any way you want. And 50 for candidate B, none for candidate C, and 50 for candidate D. Theoretically, candidate A could have received all your 900 votes. And again, In statutory, the large shareholders could have an easier time electing members of the board. But with cumulative, many of the small shareholders could decide, we all want candidate A, accumulate their votes, and candidate A may receive a seat on the board. But either way, the total number of votes in either case is 900 votes. Now let's look at a possible question. Take a minute to answer this question in your workbook. As it relates to the corporation capitalization, which of the following statements is or are true? Circle all that apply in your workbook. Number 1, the number of shares outstanding, or the number of outstanding shares, is always equal to the number of issued shares. True or not true? 2, treasury stock is previously issued shares that are no longer outstanding. 3, shareholders vote to authorize the payment of dividends. And 4, cumulative voting is most beneficial for small shareholders. So please take a minute and circle in your book which, if any of those, would apply. Okay, 2 and 4 are correct. Now, number 1 stated the number of outstanding shares is always equal to the number of issued shares. That is not true, because there could be treasury shares repurchased, like our 10 million versus 8 million example. Treasury shares is previously issued shares that are no longer outstanding. That is number 2, and that is true. Number 3 is not true, because it states shareholders vote to authorize the payment of dividends. That is false. The board of directors would authorize dividends, and if declared by the board, shareholders would receive them. And number 4 is correct, because cumulative voting is beneficial for the smaller shareholder, where statutory would be more beneficial to the larger shareholder. We're going to spend a few minutes on the term restricted stock, then control stock, then something called Rule 144, which all apply to those terms. The term restricted, as a general definition, means you're prohibited from doing something. There's a restriction. Generally speaking, we'll talk about it a little bit more in detail on the next slide, is if a person receives securities through purchase or through compensation as part of a private placement, those securities are restricted securities. And one of the reasons how they got the name restricted securities is they're restricted from being resold before a certain period of time. You just can't resell them. And in order to make sure anyone buying those securities would know about that and they couldn't be sold, there are these instructions called stop transfer instructions. And there's a legend on those securities that say these are restricted and can't be resold for a period of time. And generally speaking, you can't resell them unless you receive some type of authorization from an attorney who's represented from the issuer. There's also another term called investment letter or lockup agreement, which kind of means the same thing, although there's different terminology. Investment letter is when you buy these securities, you're stating that these are not for immediate resale to trade, that you're buying them as an investment for a longer period of time. And since you're signing a letter that says that, they refer to the term investment letter. Another term is called the lockup agreement, meaning that these shares can't be sold for a certain period of time. And one of the things people like to know about that is if you're going to buy stock in a company and senior executive own those shares, you want to make sure they can't just simply sell as many shares as they want any time they want, because that would have a negative effect on the shares that you own and could drive the price down. So if there are restricted securities, there's generally what these refer to as lockup agreements where they can't be resold for a certain period of time. So let's take the next step in our discussion on restricted securities and talk about Rule 144. Rule 144 permits the sale of restricted and control stock. And here's why they needed the rule. It actually is an exemption, Rule 144, because if you own restricted stock or control stock, which we'll define in just a minute, those shares cannot be sold unless you register them with the SEC. Now in Chapter 11, we'll talk about that discussion of registering those shares, which is pretty much a burdensome and costly project. So how can someone who owns restricted or control stock sell them without registration? Well, the answer is under SEC Rule 144, which is an exemption allowing these shares to be sold. So let's look at some definitions, please. Restricted stock, which is discussed on the last slide, is unregistered stock that's acquired through a private placement or as comp for a senior executive. So, for example, the CEO of a company, he or she might receive cash salary, but a lot of their compensation is made up of shares being given to them as compensation. And those shares will typically be restricted shares and have the legend and the lockup agreement, as we discussed earlier. A very important point for the examination is mandatory 6-month holding period. Now, it might be longer due to the letter that you signed or the lockup period, but at a very minimum, the SEC requires a minimum of 6 months. So you might be given a question on the exam that says, the CEO of a company receives restricted stock. They've held it for 3 months. How many shares could he or she sell? The answer is none. Not because of the number of shares you own. It's because if you own restricted shares and you've only held them for 90 days or 3 months, they cannot be sold because the minimum holding period is 180 days or 6 months. Now, to the right is called control, or another term for control is affiliated stock. That is stock that is currently registered in the public marketplace, but is purchased by what's referred to as a control person, a person who can control the company. And the SEC defines those individuals as any person who is an officer of the company, a director of the company, not and, but or greater than 10% shareholder. So if you're on the board of directors, you're a control person. If you're the president of the company, no matter how many shares you own, you're a control person. If you own 11% of a company, you are a control person. And if these shares are purchased, control shares, so if the CEO of a company receives some shares as compensation, those are restricted shares. If that CEO goes in the market, really believes in the company and buys additional shares, then that becomes control stock. They can sell that freely, i.e. no holding period, but as we're going to see in just a few minutes, there's a limit of the number of shares you can sell. So the restricted, the control, only refers to the holding period. Restricted shares, 6 months. Control shares, no holding period. Now, the heart of the rule is not really so much when you sell, but the quantity in which you sell. When intending to sell, the SEC must be notified. You notify them by filing what's referred to as a 144 form. And when do you place that? When do you file that form? Not prior to the sale, at the time of the sale. You're not asking the SEC, you're telling them. Now, securities may be sold over what day period? Every 90 days, you can sell a limited quantity. Every 90 days, you can sell a limited quantity. And if any shares remain unsold, you have to file an updated form. So Rule 144 isn't as concerned as when you sell, restricted versus control, we discussed that, but the quantity. The maximum number of shares you can sell every 90 days is not the lesser, but the greater of 1% of the outstanding shares or the average weekly volume over the last 4 weeks. So what you're really doing is dribbling or limiting your sale to those percentages every 90 days. Now, if you don't own that many shares, it's not a big deal. But if someone owned 30% of a company, they don't want that person to be able to dump their stock, even if they've held it for 6 months. They want to be able to sell their shares, but limited quantities every 90 days, therefore limiting the impact in the marketplace on the shares being sold by that company. Now, the bottom of that slide, I think an example would help. It says, filing Form 144 is not required if selling no more than 5,000 shares or $50,000 worth of securities, and that's every 90 days. The reason for that is if you're selling a small amount within 90 days, what the SEC is saying is don't even worry about filing a form with us. It's not really that overly important. So, for example, if you were selling 5,000 shares and you were selling those shares, and let's say the price is $9 a share, that's only $45,000. So if you're going to do that over 90 days, no filing would be required. If, however, you were selling 5,000 shares and the price was $11 a share, well, 5,000 multiplied by 11 is 55,000. Then in that case, you would be required to file Rule 144 form. One more item. Earlier I talked about the president of the company owning shares for 3 months that couldn't sell them if they were restricted shares. If that same question was asked, where the president of the company, but they bought the shares in the open market, those shares being control shares, they could sell them if they've only held them for 3 months. But when they did sell those shares, that person, they would be limited to no more than 1% of the outstanding shares or the average weekly volume over the last 4 weeks. Now let's look at an example of how that might work. Let's look at this example. ABC has 5,700,000 shares outstanding with recent trading volumes indicated below. And you see there's a number of weeks there. Now we know the rule says that you can't sell more than 1% of the outstanding shares or the average weekly volume of the last 4 weeks. So let's look at that. 1% of 5,700,000 is 57,000 shares. The last 4 weeks. We exclude January 31st because it's only the last 4 weeks. And the reason why we did this is to make the question a little bit more challenging. So if we take those 4 weeks, we add them all up, then we divide, we get 59,000 shares. So 62 plus 60 plus 56 plus 58 divided by 4 would equal 59,000 shares. You can sell 59,000 shares over the next 90 days by filing the form, but make sure you remember that it's the greater of those two. And if you look there, choice 1 has the lesser of those two. So sometimes when you get to questions on the examination, not only is it important to know the rule, but even one step further by knowing whether it's the lesser of or the greater of. So be very careful with that. Make sure you read the questions very carefully. And before you answer any question, you have to say in your mind, what is this question asking me? So the number of shares you'd be able to sell based on this example would be 59,000 shares. Now let's take a minute and discuss our next concept. And that is called ADRs, or American Depositary Receipts. What ADRs are, they represent shares of foreign companies, stock, not bonds, shares of foreign companies that are sold in the United States. And because there are different regulatory requirements as well as different currencies, people in the U.S. don't want to buy shares in a foreign currency. They want to buy something in U.S. dollars. They want to be paid a dividend in U.S. dollars. So ADRs are characterized by priced in U.S. dollars, their dividends are paid in U.S. dollars, and they could be sponsored or unsponsored. And we'll get to that in just a minute. So again, any questions on the exam that say an individual is buying shares of stock in a foreign company and buying in the United States, what have they purchased? The answer is ADRs. What will they pay? They'll pay a price in U.S. dollars. Remember, there's going to be currency fluctuations, and people in the U.S. necessarily don't want to buy these securities overseas in a foreign currency. Furthermore, the dividends won't be paid in yen or euros. They'll be paid in U.S. dollars, which makes most U.S. investors much more comfortable. Now, there are two additional terms. Sponsored versus unsponsored. Well, what does that mean? The term means that the ADR program, the conversion from foreign shares to U.S. shares, is sponsored by the actual company. Either way, they're still trading in the United States, and I'll go over a couple of examples. Sponsored is in cooperation. So, for example, a company based in China, let's call it Alibaba, decides it wants to sell you their shares in the U.S. Now, if that company, and many companies would want this, they want to list on a U.S. exchange, let's say the New York Stock Exchange or NASDAQ, and many times it's the New York Stock Exchange because many foreign owners of companies feel comfortable selling or issuing the shares in the U.S. on a U.S. recognized exchange, which would be the New York Stock Exchange or NASDAQ. So Alibaba decides it wants to list its stock on the New York Stock Exchange. And because of that, they have to have what's called sponsored ADRs. And what that refers to is the company, Alibaba, pays for and sponsors the ADR program, which means they take a certain number of shares of their company based in China, give that to U.S. Bank, And that U.S. bank then converts those foreign shares into U.S. shares and gives people a receipt they own the actual shares. And they're referred to as ADRs. For all intents and purposes, buying 1,000 shares of an ADR is like buying 1,000 shares of common stock. To the typical investor, there's no differential. Now, in some cases, the foreign company doesn't want or not interested in selling its shares in the U.S. So let's say a foreign company is not interested in trading in the U.S., but brokerage firms would like to have that company stock trading in the U.S. because they think their clients would want to buy it. An example was one I mentioned at an earlier program, I think, believe it, in the last chapter, when I mentioned the term the company Nintendo. Nintendo's based in Japan. They don't want to sell their shares in the U.S. So a brokerage firm says, well, we'll pay for the ADR program because we can make money on commissions by selling those shares. That's called an unsponsored ADR, and they will be quoted on the over-the-counter bulletin board of the pink markets. And as we learned before, those are not exchanges, but simply quotation systems. So there are literally hundreds or thousands of foreign companies that trade in the U.S., which don't involve the actual company, and they're called unsponsored ADRs. In some cases, they can be a risky investment. Most of the well-known names, so for example, Spotify is an ADR because it's based overseas, but they trade in the U.S. Alibaba is another example. There are literally hundreds of examples. The German brokerage firm Deutsche Bank is also another example of a sponsored ADR. But again, foreign companies trading their stock in the U.S. are known as ADRs. Okay, let's do some new things. We're going to do some questions and some matching concepts. First, the question. Take a minute to answer the following questions in your workbook. Question 1. What type of securities are acquired through a private placement? What type of securities are acquired through a private placement? Question number 2. What is the holding period for restricted stock? Second question, part of that first one. What is the holding period for control stock? So we have two separate answers. And the third question, which only has one part, is how many shares can be sold when filing Form 144? Okay, let's look at the answers. What type of securities are acquired when you buy securities through a private placement? They're known as restricted shares. Well, what is the holding period for restricted shares? Part of our second question. And that the answer is 6 months. However, for control stock, the holding period is there is no holding period. And lastly, when filing Form 144, the maximum number of shares you could sell is the greater of 1% of the outstanding shares of the average weekly volume over the last 4 weeks. Now, in your materials, we have an area that says classification of common stock. So what we're going to do here is a little bit of an activity, a little more interesting than simply me listing the type and repeating what they are. So sort of like a matching concept. Let's look at it. We have some types of stock on the left-hand side with their definitions on the right-hand side. So let's do our first one, and that is blue chip. So we're going to match blue chip with one of the items, one of the 6 items on the right-hand side. And that answer is, of those companies, those stocks of strong, well-established, dividend-paying companies. One of the reasons how I got the name blue chip, which is kind of a silly thing, but it is what it is when you play poker, the most expensive chip, there's a red, a blue, and a white, I believe. The most expensive is the blue chip. It's not as followed as it was years ago, but there are still some actual entities that refer to themselves, I'm a blue chip company. You know, Apple, IBM, Hewlett-Packard, Disney, some of those more well-established companies are referred to as blue chip. Our second classification is growth. And what matches up with growth? Stocks of companies with sales and earnings that are expanding fast in the economy pay little, if any, dividends. So growth companies would be those companies, when they earn their money, they don't pay a dividend, and then they retain their earnings, keep them to grow the company. What's interesting is when it first started out, Apple was a growth company. And after a while, it became a blue chip company. Microsoft was a growth company. It became a blue chip company. A company like Twitter or Facebook, they still might be in the growth phase, but one day they too may be more like blue chip companies. So it's those companies that tend to not pay dividends. They're looking for growth in the marketplace. Our third one is an income stock. And that is defined by stocks of companies that may pay higher than average dividends. Some examples would be financial service companies like banks or insurance companies. Other examples could be utility companies. You're looking for a dividend. That's why you're buying the shares. There's two main reasons to buy stock. One is appreciation. The value of the stock may rise. And you're looking for that more with a growth company, for its stock price to increase at a very high level. With a blue chip, or especially even an income stock, you're looking for the dividend to be a large part of what you receive. And some manufacturing companies also have a large dividends. The next one is defensive. And defensive means stocks of companies that are resistant or defensive against recession. So defensive stocks have nothing to do with the defense industry. What things that they always need, like pharmaceuticals, utilities, tobacco, alcoholic beverages, healthcare. The companies don't do as poorly in bad times, like a recession or bad economy. These are things, think of the defensive stocks as things you always need. Oh, another one, believe it or not, cosmetic companies. No matter what, cosmetics seem to sell pretty well. All right, next up. Sort of the opposite of defensive are cyclical stocks. Those stocks that fluctuate with the business cycle. When the economy is doing well, they do well. Examples would include, let's say, appliances, automobile, recreational things, vacations, things of that nature. When the economy does well, people spend more money buying a new washing machine, buying a new car, buying luxury, certain luxury items. You're going to need utilities. Even in bad times, you're going to need lights. They're defensive. Those companies that do well when the economy is doing well are known as cyclical. And last but not least are ADRs, or American Depository Receipts, and they are defined as facilitates the trading of foreign stocks in the U.S. market. So if a French company sold shares in the U.S., ADRs. An Australian company sold shares in the U.S., ADR. So instead of simply going through and defining these, I thought the matching concept was a good way of bringing that point home. Our next type of stock is the only other one, called preferred stock. Please make a note, preferred stock does not have voting rights. Preferred stock does not have voting rights, only common stock has voting right. Preferred stock is mainly purchased because of its dividend. People want the dividend, which is usually paid quarterly. So some people look at preferred stock as a return or an investment similar to bonds, which will be discussed more in Chapter 4. Now, preferred stock pays a stated dividend, although it's not guaranteed because the board still has to declare it. Where common stock, the dividend could change all the time. In a preferred stock, if the company is able to pay the dividend, it will pay generally the same amount. Now, the par value, or typical amount you paid, is based on $100. So if someone said, I own 3% preferred stock, that would mean that they would receive 3% of $100, and 3% of $100 is $3. And those $3 will be paid over a period of 4 quarters. So it would be $1.50, 75 cents. $1.50 would be every 6 months. But since they're paid quarterly, you'd receive 75 cents per quarter with a total dividend of $3. And please remember that dividends of preferred stock must be paid prior to any dividends paid with common stock. Now, there are various types of preferred stock. There's many different classifications of preferred stock, and let's talk about them on the next slide. Non-cumulative or cumulative. And we can put those on together because you either have one or the other. So the question is, if the company that issues the preferred stock cannot pay its dividends, do they or do they not accumulate? And do they have to be paid out before any shares or any dividends can be paid to the common shareholders? Well, if it's non-cumulative, there's no requirement to pay those arrear dividends. If they're cumulative, there is. So a preferred stock can be cumulative or non-cumulative. And in a few minutes, I'll show you an example of how that might work. Another characteristic could be callable, which allows the issuer to redeem those shares of preferred stock at some point in time. Remember, preferred stock doesn't have a final maturity date. It could last forever. So the company might decide, you know what, I don't want to pay that dividend anymore. I needed the money. I needed to pay the dividend because I issued the preferred shares. So now I don't want them anymore. So they may be callable. So the issue might say, well, they're callable at 105. Well, you bought the shares and the par value is $100, and they say it's callable at 105. That means for each share of preferred stock you have, you'd receive $105 or 105% of $100. Now remember, most companies that have common stock don't also have preferred stock. There are only select companies that do have both common and preferred, and they tend to be more established companies like the blue chip companies or the income companies like financial service companies, banks, utility companies, insurance companies, things like that. Another characteristic can be participating, which allows, not requires, the investor to receive extra dividends. So if the dividend was normally $3 per year, if they had a good year and they were participating, the company could decide, if they wanted to pay a higher dividend. But most preferred stock is not participating. And last but not least is convertible preferred, which allows the holder who owns convertible shares of stock, the preferred stock, to convert into common stock. Now that we've discussed cumulative versus non-cumulative preferred stock, let's do an example of how that would work in the real world. Imagine for a second, ABC Corporation intends to pay a dividend to its common shareholders in year 3. Let's assume they have two types of preferred stock. One, 8% preferred stock, which is non-cumulative, and 6% preferred stock that is cumulative. And then they want to pay a dividend to common shareholders. Remember, a dividend cannot be paid to common shareholders unless you've paid a dividend first to preferred shareholders, but the question is how much. So let's start with the following. In year 1 was not a good year. They were supposed to pay an $8 dividend to the preferred, the 8% preferred, and the reason I got $8 is 8% of $100, which is par value. 6% of $100 is $6. So in year 1, they paid no dividend to the preferred shareholders, and of course, since they didn't pay preferred, common received nothing. In year 2 was a little bit better of a year, but not as bad as year 1. They were supposed to pay 8, they paid 2. They were supposed to pay 6, but only paid 2. Well, since they didn't pay what they were supposed to pay the preferred shareholders, they can pay common nothing. So the question is, they have a good year, year 3, and they want to pay common shareholders a dividend. What do they need to pay in year 3 to the 8% and the 6% preferred? Well, since the 8% is non-cumulative, it's not cumulative, then they only have to pay $8. However, the 6% is cumulative, which means they owe money in year 1 and year 2 on that. And if they want to pay a common dividend, they have to pay what they owe to the 6% preferred. The question is, if they didn't want to pay common shareholders a dividend or weren't anticipating such, then it wouldn't be an issue. But the question specifically says they want to pay a dividend to the common shareholders in year 3. Well, if it's 8% non-cumulative, all they need to pay is $8. But what about the 6% cumulative? Well, you owed 6 in year 1, you paid 0, so you owe 6. You were supposed to pay $6 in year 2, you only paid 2. So you owe 4 for that year, 6 for the other year equals 10, plus the 6 you owe in year 3, which means the cumulative 6% preferred, you'd have to pay a dividend of $16 in order to pay common shareholders whatever amount you wanted to. So again, it's a comparison between cumulative and not cumulative, and this example here shows the difference what would happen in year 3. Now let's discuss convertible preferred stock. So let's talk in generalities, and then we'll discuss some of the details on this slide. Well, imagine for a second an investor purchases or bought a 4% $100 par value convertible preferred stock at $110 per share. Stock is convertible at $10, and the common stock price has risen to $12. Now, before we get to the rest of the slide, let's discuss convertible preferred in general. If you own convertible preferred and there is a 4% or $4 dividend, which is 4% of $100, regardless of what happens to the common stock price, you will receive those $4 as long as they can pay that dividend. So the value of the common stock does not affect the 4% rate. So think of convertible preferred as not as risky as common stock, because with common stock you may not receive any dividend. But with preferred convertible, you do receive some type of dividend. And if the value of the common stock rises, the value of the convertible preferred should rise as well. So it's somewhere between, we call it a hybrid. It's not common stock, it's not preferred stock, a little bit of each, and they refer to it as a hybrid security. Many large institutional investors like convertible preferred stock, a little bit of everything. Berkshire Hathaway, periodically, when they invest in companies, will buy convertible preferred stock as well. But let's go through the details of the information on this slide. First question says, what is the conversion ratio? Which means how many shares of common stock would I receive if I own this convertible preferred? Well, the way to calculate this is take the par value, which is $100, and divide by the conversion price, which is $10 per share. That equals 10 shares. So if I want to convert my preferred stock into common stock, I'd receive 10 shares of common stock for every share of preferred stock that I own. Now, second, based on the increased price of the common stock, at what price should the preferred stock be trading? Well, the common stock conversion price is 10, but the common stock price has risen to 12. So what should that stock be trading at? And here's how we calculate it. We take the market value of the common and multiply that by the conversion ratio. That should equal the current price of the preferred. So if the common stock is $12 a share and the conversion ratio is $10 a share, the preferred stock should now be trading at $120 per share. So since the price of the common stock has risen to 12, the convertible stock should be trading at 120. So if you bought it at 110 and the common stock has risen, then the preferred stock should rise to at least 120. We were assuming when you bought the stock, the stock price was not $12 a share, and the price increased from $10 a share to $12 a share, and therefore the price of the preferred stock rose accordingly. Let's do another activity. Go to the workbook and complete the preferred stock activity. Reach each characteristic and then determine the type of preferred stock to which it applies. Allow stockholders to share in dividends paid to common shareholders. Participating preferred stock. So that's the characteristics. Participating preferred stock. Next, permits the issuer to remove the stock from the marketplace. What type of preferred stock would that be? Callable preferred stock. 3, makes up for dividends that are not paid in previous years. What characteristic goes with that? The answer? Cumulative preferred stock. And lastly, preferred stock that can be exchangeable or exchanged into common stock. And that is known as convertible preferred stock. Okay. One more section we're going to need to talk about, and that is derivatives, and then some miscellaneous equity rules. Preemptive rights. Very important point. A shareholder's right to maintain percentage ownership, no dilution, no reduced ownership, is distributed for a rights offering. One right for each share owned. Very important point. Please make sure you put this in your notes. Only if you own shares of common stock will you receive any rights. If you own shares of preferred stock, you will not receive any rights. It's only for common shareholders, which is interesting because there could be some tricky questions on the exam that says, you own 1,000 shares of preferred stock, there's a rights offering, how many rights would you receive? The answer is 0. Now, if you owned 1,000 shares of common stock, you would receive 1,000 rights. Then, based upon some formula which will be given to you on the exam, it takes a certain number of rights to buy one new share plus a certain amount of dollars. And those dollars are called the subscription price. Now that's discounted. Shareholders exercising rights at a price below the current market price prior to a public offering. And we use the term immediate intrinsic value. Let's go through that. What a rights offering is a way in which a company that's already public can raise additional capital, kind of like the term follow-on offering, but do it in such a way, instead of asking a new group of shareholders to buy their shares, they go directly to the existing shareholders and say, hey, you like our stock, would you like to buy more of those shares? Especially when we give you a discount. Now, if the stock price is 20 and you told an investor, well, we'll allow you to buy the stock at 21, what good is that? So the common stock price is 20 and you allow the investor, the shareholder, to buy shares at, let's say, 18, a discount. What we mean by immediate intrinsic value is $2 per share. In other words, you could buy something at 18 that is currently selling at 20. It's worth at least, intrinsically, really, at least $2. The lower that price is, i.e. the lower the subscription price is, the more intrinsic value there is. But the lower that subscription price, the less the company can make in terms of its money. If it's only selling the shares at 18, it'll make X. If it's selling the shares at 19, a little less of a discount, they would make more money, but would be less advantageous for the shareholders. And they are short term. Rights only allow you to buy those shares for a limited period of time, and they are tradable. What they mean by tradable is if you own shares of common stock and you receive rights in a rights offering, they trade for about 4 to 6 weeks based upon their intrinsic value and how much time they have left until they expire. Sort of like a coupon that expires. Generally speaking, the rights will trade on the same exchange as the underlying stock. So for example, some years ago, a certain brokerage firm called UBS Securities, as well as some other firms as well, Barclays did it as well, and so did Credit Suisse, is they had a rights offering. And since the common stock traded on the floor of the New York Stock Exchange, the rights will also trade there for that period of time. So as an investor, and you own shares of common stock, you receive rights. You can either subscribe to the offering and buy the new shares, or not subscribe to the rights offering and sell your rights for a certain dollar amount. Here's an interesting fact. If you own shares of common stock and there's a rights offering, and you do subscribe and pay the money, your ownership percentage will not change, i.e. no dilution. If you decide not to buy those shares, there'll be more shares outstanding and you'll still own the same amount, so your ownership percentage of the company would be diluted or be reduced. And again, rights are a type of derivative because their price or their value is derived or comes from whatever the value of the common stock is. So if the rights are exercisable at 18 and the stock is 20, it's $2 of value. If the stock then rises to 22, now it has $4 of value. So the value of that right is contingent or is derived on or based upon the value of the common stock as compared to what's referred to as subscription price. So rights are given to you if you already own shares of stock, where warrants are generally provided to you when you buy the original shares or original bonds. So think of warrants as like a sweetener or a marketing thing that are attached to an offering of securities for the first time in the primary market, where the company says, we think that if we sell bonds or common stock by themselves or preferred stock by themselves, it may not attract the audience or the investors we want. So let's add something to that security. So they add the warrants, and warrants give you the right to buy shares at usually a price above the current price, and they're generally long-term. Long-term, some warrants could actually be perpetual, and some warrants could be 5 years or 10 years. And they are detachable, which means when you buy the security itself, sometimes it's referred to as a unit, and that unit consists of one bond plus one warrant, or one share of common stock and one warrant, or one share of preferred stock and a warrant. And then the warrant trades separately from the underlying security. So in that respect, it's similar to rights because they do trade separately. The main difference, and there's a few others that I'll summarize in just a few minutes, but the main difference is warrants are attached to a securities offering, then trade separately, where rights are given to you when you already own the shares. Let's look at a comparison chart. Rights are issued to shareholders and warrants are attached to a new issue. Rights are generally very short term, while warrants are long term and could even be perpetual. The exercise price for a right is usually below the market price to make it attractive, and warrants exercisable above the price. In other words, the common stock might be 10 and the warrants are exercisable, let's say 12 or 15 for a certain number of years, making it attractive but only if you hold the security for a certain period of time and the value of the common stock rises. So warrants are long-term and rights are short-term. A few miscellaneous equity rules. In the SIE outline, there's a few rules mentioned relevant to equities, and these three rules are actually not going to be related to each other. First one is FINRA Rule 2261, disclosure financial condition. It says, upon request, a member firm must make its balance sheet available to customers in the physical or electronic form. What that means is any brokerage firm is required, i.e. member firm, to provide customers of that firm with a balance sheet. Generally, physical form means you send it to them. Electronic form means you post it to your website. So that's pretty basic. The idea being is that if you're a brokerage firm, clients of your firm have a right to know what is your financial makeup or balance sheet. Next, FINRA Rule 2262, disclosure of control relationship with issuer. Before executing a trade in the issuer's securities, the broker-dealer must disclose to its customers if it has a control relationship with that issuer. What does that mean in English? Here's the answer. Your broker and your client is going to be purchasing from you shares of Bank of America. Shares of Bank of America. The broker works at Merrill Lynch. Merrill Lynch is owned by Bank of America. Well, you have a requirement to disclose, hey, you're buying shares of Bank of America and Bank of America owns my company, Merrill Lynch, that I work at. Is that if the brokerage firm is a publicly held company or subsidiary of a publicly held company and the client is going to buy shares, you must disclose it to them. And please remember, you must disclose it not afterwards, but before or at the time. And lastly is 10b-18. Now, earlier in the presentation in Chapter 3, we mentioned a stock buyback. Well, the SEC is concerned that if companies buy back its own stock in the marketplace and use brokerage firms to do that, they could be manipulating the stock and causing the price to go up in the short term. They could be manipulating the stock. So the SEC created 10b-18 as quote-unquote a safe harbor. And what that simply means is that you are safe and will not be accused of any violation if you follow the guidelines. You know, you drive the speed limit, you don't text and drive, you won't get a ticket. And there are four main categories. One, on any given day that the company does a buyback, they can only use one brokerage firm. So if Apple wants to buy back its stock on a Tuesday, they can only use one brokerage firm on that Tuesday. In addition to only using one firm, number two, you got to be careful when you buy it. Don't buy it early in the morning or late in the day, the most influential time of trading. Three, be careful what price you buy it for. There's certain restrictions. And fourth, be careful how much you buy. If you follow these four guidelines, you'll be safe and you won't be accused of any violations. And that's known as 10b-18 or the safe harbor for stock buybacks. Let's do our final activity. Go to your workbook and complete the rights, warrants, and equity rules activity. Read each statement and determine, is it true or is that statement false? Is that statement true or is that statement false? Let's go through it. Number one, preemptive rights have immediate intrinsic value. True or false? The answer is true. They have immediate intrinsic value. That was an example where it's a discount If the stock price is 20, you can buy the shares at 16 or 18. That's immediate intrinsic value. Number 2, warrants may be exercised within a short period of time from issuance. That is false. That is not true. Warrants are long-term. Number 3, customers must be made aware afterwards of the control relationship. That is false, because you have to do it at or prior to, not afterwards. And lastly, only one brokerage firm or broker-dealer can be used when an issuer is purchasing its own stock, and that is true. That concludes Chapter 3. Chapter 4 is next, which is very exciting. Welcome to the wonderful world of debt instruments or bonds, where they'll be discussing the characteristics of bonds, price versus yield, how debt is retired, and convertible bonds. I'll see you soon. Please feel free to review this as many times as you want and use the workbook to answer the questions.